Order blocks versus fair value gaps, which is stronger? Most traders generally confuse order blocks and fair value gaps, but institutions use them differently. Understanding these two concepts is the key to spotting where big money enters and exits the market. In this guide, I'll break down what order blocks are, what fair value gaps are, what are the strengths and weaknesses of each, and how to combine them to make a perfect entries. And at the end of this video, I'll show you a page which has a special indicator which automatically marks out all the fair value gaps and order blocks for you on the chart, saving your time and avoiding all the guesswork. Starting off with what is order block and what is a fair value gap. Institutions trading secrets, these both are. Now, first thing, order block. An order block is a price zone where institutions place large buy or sell orders. Now, let's imagine there is a support region. Whenever market taps this zone, it gives a sudden upward pullback. So this zone, this rectangular zone is called as an order block. Now this order block is generally used by traders to place trades, because here institutions have their pending orders left here. So whenever the price reaches this zone, the sudden spike in price causes a very great momentum and giving you a very good TP. You can enter here putting your stop loss below this zone and take profit 1:2 minimum. Now, supply order block and demand order block. These are of two types. Supply order block is last bullish candle before a sharp drop. It is like a resistance zone, but where sharp movement of sharp selling comes. This is called as a supply order block. Whereas a demand order block is a rectangular zone where sharp buy side sells or buy side trades come. So this is what is called as demand order block, and this is called as supply order block. Now, what is a fair value gap? Fair value gap is generally a price imbalance which is created one side of the market dominates. When buyers dominate, a fair value gap is created. When sellers dominate, a fair value gap is created. And markets generally return to this fair value gaps to fill it. Now let's see how is a fair value gap created. It's a 3-candle pattern. Like there are two types of fair value gaps. Let's start with 3 continuous green candles. 3 continuous green candles. Now the second candle top and the second candle bottom is a fair value gap. Whenever price goes above it and again retests onto this zone, you generally go for longs, putting your stop loss below the fair value gap. And this gap, after price reaches here, this gap makes sure the trend is continued in an upward trend. Make sure it continues. And next type of fair value gap is a inverse fair value gap, when market is completely moving downwards in a bearish trend, and again the second candle body is marked, wick, the lower wick and upper wick is marked. Again when price comes back to this zone, it gives us sharp selling. Now this is what is called as an inverse fair value gap, and this makes sure that the bearish trend continues. This makes sure that the bullish trend is continued. Now, order block versus fair value gap, strengths and weaknesses. Starting with order block. These are institutional footprints and high probability reversal zones. So in this, you should generally rely on the higher time frame more. Higher time frame works more efficiently than lower in both order blocks and fair value gaps. So generally trade order blocks on daily time frame or 4-hour time frame. And it can fail if liquidity is swept first. If you don't know what liquidity sweep is, I already uploaded a video. You can find the video at the end of this video. And it requires patience because some zones can be tested till the depth and few can give a false breakout, but you should make sure wait for a perfect reversal entry, or make sure you get a very good candlestick pattern which confirms your trade entry. Now what a fair value gap is. As I said, cleared 3-candle pattern. It is excellent for scalping. In lower time frames, you can go like 5 minutes or 15 minutes and you can take instant trades, although they are generally weak in lower time frame. Gap fills don't always hold a support or resistance. These gaps which are created, they do not act as a support and resistance. So that is a little risky part, because orders are there, but the orders might not be too much. Sometimes it might just come to here and again go down. So it is less reliable on lower time frames alone. If you find a fair value gap which is working on daily time frame, 4 hour and 15 minute, then that is the most perfect fair value gap you can ever find. Now, to avoid all that, we combine order block and fair value gap. I'll give you a very good technique. Anytime if you see two fair value gaps and an order block below it, avoid trading in the fair value gaps zone. Wait for market to come and tap the order block and then enter, placing your stop loss below the order block. How does this help? This makes sure that the fair value gap traders are completely trapped, so more liquidity will be in this zone. So now, how first you identify an order block? Go to higher time frames, daily time frames, next 4 hour, 1 hour, 15. Keep identifying from higher time frame to lower time frame. Next, locate fair value gap in the same way, higher to lower. Next thing, wait for a retest. Like this is a zone which has a order block and a fair value gap as well. Once market taps this, wait for a retest. Second tap, take long. Third thing, confirm entry. Check out for a liquidity sweep or a very good candle pattern. And a fair value gap inside an order block zone creates a high probability entry. This is an A++ setup if you find this. It generally happens frequently. Now, practical trading tips. Start with higher time frame and then go to lower. Wait for confirmation or act only when order block plus fair value gap you find. Avoid only fair value gap, avoid only order block. Next thing, use fair value gaps as a perfect entry. Don't use it as a zone, because order block is doing your zone work. Use fair value gap as a perfect sharp entry. And next thing, manage your risk by putting your stop loss below the zone. Now, main takeaway. What is an order block? It is an institutional footprints where banks place large order. Fair value gap is market inefficiency, a price imbalance that typically gets filled. Together, they make a really good setup. And now, the most awaited part which you all have been waiting for is the indicator. Now I'm going to show you an indicator which marks out all your order blocks and fair value gaps. Just head on to TradingView, go to the indicator section and apply this indicator FVG and Smart Money Concept by Luxalco. These two indicators are gonna do the thing for you. First thing, fair value gap and Smart Money Concept by Luxalco. When you apply, your chart starts looking like this. This is a Euro USD chart. Let's go to 15-minute time frame. Let's start with the first one, okay? Fair value gaps. This is a fair value gap indicator which you applied. Name was FVG. So in this, you see here it already marked out the fair value gap for you. This is your first fair value gap. This is a lower fair value gap. You can go to different time frames and it does the same thing. It marks out all the fair value gaps for you. And the red ones are inverse fair value gaps. In a downtrend, the fair value gaps formed. They are those. Green ones are upside fair value gaps. We should look for longs near the green fair value gaps, short near the red fair value gaps. And the next indicator which we have, first we'll hide this. The next indicator which we have is order blocks. Now this indicator, when we hop on to 30 minutes, you see a blue zone. This is called as a order block zone, where when market taps this zone, you enter for longs. Now you see here it is tapped this. We go for longs here, placing the stop loss below the zone. Placing the stop loss below the zone and aiming for 1:2 risk reward. These were the support resistances which I had drawn earlier. So that's how this demand order block works. And the red one is sell side. So whenever the market taps these red zones, you look for short, and the blue zones you look for long. And this Smart Money Concept indicator also marks out break of structure and change of character. BOS stands for break of structure and CHOCH stands for change of character. And now what an A++ setup looks like, let me show you. Now look at this zone. There's a fair value gap here, a fair value gap below that, a fair value gap below that, and then an order block here. So here you wait for the market to come, take the liquidity of these fair value gap traders, hit their stop loss, and then tap to your zone. And then you go long from here, placing your stop loss below this order block and aiming for a 1:2 risk reward. This is what an A++ setup in fair value gaps look like. And yeah, that's it for the video. If you have any sorts of doubt, you can ask in the comment section, or you can message me on my Instagram. Link is in the description. Thank you. Happy trading.